We're talking about the bond markets in Nigeria, prospect and opportunities. Sonnie, if you take a look at the history of all great nations, J.P. Morgan, he created the bond market to fund the development of America's infrastructure, railroads,
absolutely,
and the whole works. And I think that's the story of the bond market.
Correct.
It's the bond market that funds infrastructure development.
Correct.
That puts a country
on the map
where it goes.
To glory.
The Euro Channel, we talked about it then. I think then people thought it was a disaster, but again, the bond market funded that huge project. Now, I think it's made its money over I don't know how many times.
Absolutely.
So how can we deploy the bond market in Nigeria to finance our infrastructure development that we all yearn for?
Fantastic question. I think the issue is this. When you look at infrastructure projects, generally speaking, they're issued by special purpose vehicles. You have sponsors that would sponsor the project, etc. So they're things that essentially you expect they would pay back on their own cash flows. Now, I think I'll take the example of Eurotunnel, right? Eurotunnel, even though it was a huge syndicated loan at the time, which could have been a bond anyway, right? The same thing is that the issue there is that you take a risk based on cash flows. Now, in a country like Nigeria, where people, I think the credit culture, right, even from the institutional investor, is still not yet built up, right? I think what I would love to see is where the federal government, with its essentially AAA credit risk, is able to provide what I would call partial guarantees, right, or guarantees to infrastructure projects. So let me give an example. The most important thing that any country needs to develop, right, is essentially that country's ability to mobilize domestic capital. And sometimes I hear people talk about FDIs. FDIs doesn't come in if you do not have domestic capital already flowing, because they actually come in to complement, right, your domestic capital. In other words, nobody from outside would invest in an asset that the indigents or the citizens of that country are not investing in. So today, what we have is you have pension funds that are being mobilized effectively on a monthly basis, right? How do you now use that to drive growth? Now, a pension fund manager is not what I would call a project, analyst. Probably can't analyze projects, etc.
Does it have to? It doesn't need to?
Well, in some circumstances, yes. In the sense whereby you would have, if I had a pension fund company, I would have investment managers. I would also have a credit department. So I'd have people who can analyze credit, all right, and who can make credit recommendations, to managers, and that goes obviously to a credit committee, and that's approved. Now, but taking a step back and saying, how do I get that pension fund manager comfortable? Let me use the term baby steps. How do I get him or her to feel comfortable that I can put, billions into a project, at least initially, until I can see that these projects work? Is that you then have people like the federal government come in and say, you know what, I will provide a guarantee. It's not cash, but it's a guarantee, all right, that says if the project doesn't work, right, you get either 100% or you get some of your money back. Now, what that does effectively, it gives, essentially, it's like what I'd call like the catalyst, all right, that now unlocks monies going into infrastructure. I think another example I can use, if you look at AMCON, the AMCON bond on its own probably would have worked, because people would say they're non-performing loans. How do I invest in non-performing loans? The reason why people bought those bonds was because they were guaranteed by the government. Now, in all probability, AMCON would probably outperform anything, right, that anybody ever expected. But on day one, if they didn't have that guarantee, they never would have raised that money. So that, in a way, gives you an example of how you can mobilize or use the credit of the federal government without actually putting down one kobo.
But if we said, okay, let's even fix all the roads, the major highways in the country, let's fix those to start with. Yeah. How would that work? Would it be the government raising the bonds, or would it be a private sector? How would it work?
Okay.
Who would do the analysis and price the bond, rate the bond,
right,
and then now ask government to put the guarantee? What will be?
Okay, let me give an example. Let's take the Lekki the Lekki Expressway.
Which one? The controversial one?
Yeah, exactly. Right? Now, that's controversial today because of the social consequences, which we identified years ago. Even when I was at IFC, they say, look, you want to have social consequences here. It's difficult to have just one road and not have alternatives, although they would argue that's an alternative. But, I mean, anyway, without going into the issues of that, what I want to go into is the mechanics of how that worked, is that you have a sponsor. All right. So generally speaking, it's normally what I would call a PPP.
Well, let's use the Lagos-Ibadan Expressway.
Okay. So
there was a concession.
Yes. So there's exactly. So there's concession, etc. Now the point is, now that sponsor now says, I've got a concession that says I would develop this road and I would now put in a toll and that will pay me back my investment. Now that concessionaire now needs to raise the money, all right, to actually construct the road. Now, if he goes and says, okay, look, guys, let's go to the market and try and raise money based on expected future flows of toll receipts. Now, with sophisticated investors, no problem. We've looked at it before. We understand how it works. We can analyze it, and we can put all the things in place to make sure that, you know what, we'll get our cash flows back. In a market like this, people are not that yet. You know, we're not yet there. We will get there, but we're not yet there. So what you do is to say, well, how do you now get the investor to feel comfortable? It's like saying, I've never done something before, right? How do you now get somebody to say, well, if you've never done something before, let me give you comfort, such that basically, at least when you try it the first time and you see that it works, you're now more comfortable doing the second time. So effectively, what you want to do is to say, look, the question comes in, maybe you have either through the Ministry of Finance or etc., where you can apply for guarantees. And what can happen then? I mean, even this has happened before. I mean, Federal Mortgage Bank, when they did the housing, exactly. There was a transaction that we put together back in 2000, and I think it closed in 2007. That bond was effectively guaranteed by what? The federal government, 100%. If that wasn't the case, that bond never would have flown. Nobody would have bought it. So the point basically is that at least today, nobody has ever come back and said, I didn't get my interest on a 6-monthly basis, right? So the point basically is that it's really, I would say, I always use the term baby steps. It's like, you know, getting the baby to walk. And then once the baby starts walking, you know, you can say, I can leave you alone now because I've learned, I understand it, I can now continue to invest there. So I think, you know, replication of things like the 100 billion guarantee for the Federal Mortgage Bank bond, AMCON, etc. Those are the kind of things that will get the infrastructure market going. So power, for instance. A lot of investors have never invested in power projects. They probably understand how the cash flows would work, right? Distribution, transmission, you know, and generation. But if you said to people, okay, come put money, then everyone said, well, no, I don't understand, whatever. Now, if you said, listen, okay, you know what? We'll guarantee it. Ah, well, since it's government risk, I'll put money. Now, they put the money because it's government risk, but later on now understand how the cash flows work. And
they don't need that guarantee anymore.
Voila. And that's it. And that's how you get, that's like the foundation. And then it grows. And then people start to understand different asset classes, how they work, etc. And then the government can now step back. So in other words, what it's done is like it's helped the baby begin to walk and then left it. And then it grows.
Okay, interesting. So I believe, so it's a question of getting sponsors and the government together.
Well, it's the same thing as your, public-private partnerships. Absolutely. But now it's just having the government actually playing an active role without. And remember, you know, the more projects you have, right, the more it now starts to look like a portfolio. You know, and when you look at portfolios, it now becomes an expected loss type expenditure. So in other words, what you're saying is, you know, I have 1,000 projects. Maybe 2 may go bad. Maybe 3 may go bad.
So it's diversified. You've mitigated your risks.
Absolutely.
And basically, you know where you are.
Absolutely. You see, so that way, it significantly, if you look at the return vis-a-vis expected loss, return would, in all probability, significantly exceed